All right, good deal. Hey, good evening, and welcome to another Retirement Readiness Thursdays. I am Drake Riggs with Obsidian Wisdom. Today, as we had promised last week, and I look forward to our time together, we are going to be discussing how to create a tax-free retirement. So, the reason I do think that this is going to be a great place for us to start is let's go through a handful of strategies. I think ideally we all want to make sure that we get most of our money back in retirement. And so I do think that that is something that we hear a lot about, but it's not always so straight and narrow. I think most of the time when I see someone talk about tax free stuff, 99% of the time they're just talking only about like insurance products. I think most of the time I see them, they talk about insurance products. So today I thought it would be beneficial for us to have a discussion where we can talk about a variety of strategies, and then you can decide which ones make the most sense for you. And so for that, I will be sharing my whiteboard as I normally am, and we will build this case study, and we'll go through the different strategies, and then you can decide what makes the most sense for you. But the one thing I do want to make sure that we all agree upon is it's all about awareness and just being introduced to some of these concepts. It takes a while to really understand it, but I really do want you to be comfortable just with the idea that, yeah, maybe it takes a little bit of prep ahead of time. Maybe it's a little bit of strategies that I have to think through, but it's okay, right? The idea that someone is out there doing this right now, that there's someone out there who's paying fewer taxes with more revenue, more income, and so we can do the same ourselves. So first, it's important to discuss just why it's important from a retirement planning perspective. And when you're really looking at it from a retirement planning perspective, we really have to acknowledge the fact that there are already us diversifying our income streams. We know that 65% of self-made millionaires have at least three streams of income. We know about diversifying from a risk perspective, that I know that I can get a certain return, but it's a trade-off with a certain amount of risk. And it depends on things like my risk tolerance, how soon I need to retire, which we call our time horizon, which I don't know why we name it that. And there's a variety of factors that helps us decide our risk tolerance. Well, we also can diversify from a tax perspective. And there are multiple things that we think of when it comes to that as well. So first, let's talk about the where your money is almost always going to have to be, right? There's really three choices that you always have. First and foremost, we can have our money that is going to be taxed. So for the most part, that means that this money is after tax. I've already received it after Uncle Sam has taxed it. And when I say Uncle Sam has taxed it, I mean that when it went to my employer and it went into my bank account, Uncle Sam already withheld taxes and the business withheld taxes. And any amount that I did not give on my tax bill, when the new tax year comes, I have to pay that back, right? We call that filing taxes. Some of us have overpaid and we get a tax return. And then some of us have underpaid and we have a tax bill. I do think it's important to recognize that getting a tax return is not always the best approach. It depends really on each of us on an individual basis. But if you just talk about it purely from a financial perspective, you are giving Uncle Sam your money at a 0% interest rate. He is then investing and spending that money. And then he gives you back the excess money a year later with no interest on it whatsoever. That if you were able to have that money and you just invested it in literally anything, you would have beaten the return that Uncle Sam gave you, which was 0%. And then if you count taxes, then you already know that it's even less than 0%. So when you look at your after tax, it means I already paid taxes on it. So what type of accounts are these? These are really going to be anything that's sitting inside of your bank account. This is going to be anything that you have in what we would call a brokerage account. And this just really is your own investment fund. If you have Robinhood, if you have a Schwab account or Fidelity, if you have E-Trade or anything like that, all of those would be what we would consider a brokerage account. That just means that it's money that I am receiving and I've already paid tax on it and I'm investing it. Because I'm investing it, we already know that that means that money has been taxed at least one time. And so then that would be in our taxable bucket. And so we can have we'll keep going. You can have any CDs in this one. You can have money market accounts. You'll have your real estate, like your rental income, and then you'll have your business income. Right. So all of these would be considered tax accounts. This is where the money is going to normally be coming. And then you'd have whatever you have. So inside of your brokerage account, for some of you, you'll have your mutual funds. And then others of you, you'll just have like your regular stock investments. All of that will be inside of there. So that's your tax bucket. The way that that is taxed, because after tax, normally it's going to be something that ends up being slightly more favorable. And so we sometimes will be taxed at capital gains, right? So we're going to say capital gains, which for most of you will be 10, 15, 20%. For most of you will be somewhere around there. So you're going to find yourself at a very much more favorable tax rate for the capital gains. Whenever you hear Warren Buffett and everyone, we're like, oh, his secretary gets taxed more than him, right? We're talking about he's taking income from his investments, his capital gains, which is a much more favorable tax rate. He's probably paying his secretary phenomenally. And so she is just taking earned income. And as a result, she is being taxed in the upwards of 30, 35, 37%. Right. So that's what we're talking about. Not that she pays literally a dollar amount more than him, because obviously she doesn't. But what we are saying is, as a taxable income percentage, she's being taxed at a higher tax rate, which is generally going to be true. And so with the real estate and your business, you have your profits, you can write off a lot of business expenses. We'll get into that a little bit later. And then even when you talk about real estate and things like that, you have the ability to write off a lot of expenses as well. And then you can carry losses forward and all those fancy things. We talk a lot about a lot of those different strategies. Your second bucket will be your tax deferred. So tax deferred is a very fancy way of saying that the money that is invested in these accounts has not been taxed yet. It's never been put in my hand, so I don't have to claim it as income, which is kind of nice. I get to deduct it actually. And so Uncle Sam loves to incentivize us to invest in our retirement account because he doesn't want to have to pay our tax bill, or he doesn't actually want to pay our living expenses once we're retired. And so Uncle Sam's like, look, I don't want your only income to be Social Security. And it says that right on the Social Security website. We don't want this to be your only income. As a result, we want to encourage you to put money away for your own retirement because we don't want you to depend on Social Security, right? That's what Uncle Sam would say. And so because this is tax deferred, that would make this a pre-tax account. You have not paid any taxes on this yet. Inside of my pre-tax account, that could be my 401k. That could be my 403b. If you don't have anything offered through your employer, then that would be your IRA account. So you can have your IRA that's set there. And you also can find like your SEPs and your simples, but we won't go into too much. So like your SEP and your simples. Right. So we're able to put all this amount in pre-tax. That means that it's not considered income for us. And then any money that is taken out in retirement in this bucket will be taxed as ordinary income, right? That's what OI is. OI is ordinary income. So that means as soon as you touch any of these accounts in your retirement, they're going to be taxed at your ordinary income tax rate. And the reason that this used to be basically the gold standard of retirement planning, because you used to have upwards of 90% of your income being taxed back in like the 1980s. And so they created the 401k, a tax deferred account. And the idea was, well, if you make $100,000 and instead of you paying taxes, I think it would have been maybe 59% would have been your all-in tax bracket. How about we defer 20% of your salary or so? We had more brackets back then. And as a result, you could actually lower your bracket and be taxed at a much less tax rate, a much lower tax rate, right? Much less. I don't know if that, where'd you go to school, Dre? A much more favorable tax rate. The issue with that in today's time is a couple fold. So one is we don't have that many brackets anymore. And there's 7 brackets currently. And because there's only 7 brackets, that means it's a lot more difficult for me to actually move into a different tax rate. And I will share with you, so this was last year, so this isn't going to be this year's, but I will share with you last year's. And so this is the tax rates that we had in 2024. And you can see that in 2024, that your first $11,600 would have been taxed at 10%. The excess of that would have been taxed at 12%. And you can start seeing that it's a pretty big gap. That if you were someone who was already going to be taxed at, $100,000, if you save $20,000, look, you're still in the exact same tax bracket. You'd have to save half of your salary to actually drop from the 22 to a 12% tax bracket with today's brackets because they're so much larger. And so you can see that it takes a lot to actually change your tax bracket. And that is the issue that we're running into now, where we're like, hey, I'm going to defer it, I'm going to defer it, I'm going to defer it. And then when I retire, I'll be in a lower tax bracket. Well, I don't know. Will you actually be in a lower tax bracket? Right? I don't know. And you can see why it's not a slam dunk anymore. Because for most people, you're going to be saving 20 to 30% of your salary. So if you were making $100,000 and you were saving 20 to 30% of your salary, you would still be in the 22% tax bracket. Now, back in the 1980s, if you saved $20,000, you actually would have lowered your taxes considerably because you would have dropped more than one bracket, because that's how many brackets there used to be. Also, because upwards of 90% of your salary could be taxed at some rate, it also it was like a slam dunk in the sense that I'm going to be saving on taxes. That's not even a guarantee really anymore. That we're already at historically low tax rates. You hear people say it all the time, historically low tax rates. So then the question becomes, with $37 trillion in debt, with all the stuff that you're seeing going on, all the volatility, all the confusion, we don't know what's going on. Do we know for sure taxes will be lower in 10 to 20 years when someone retires? And I would say we don't know for sure. We don't actually know for a fact that tax will be lower in the future. So imagine that you're someone who is going to pay right 22%, and you defer into the future and the taxes are actually higher, right? Because that is on the table. I'm not saying that it's going to happen. I'm saying it's at least on the table. It's something that in 2025 that you have to consider. The benefit that you had in the previous time is you were at $100,000, which would have been at a 59% tax bracket back in the 80s. And now, if you're retiring now, look at that. You would be at 22%. You would have cut your taxes more than half. So that strategy worked really well back then, and it's something that was the gold standard, and it's something that was a slam dunk. It is not as much of a slam dunk today, as you can see. You can't for certain say that just deferring all of my taxes into my retirement and then paying ordinary income tax is the best approach for you, which is why we often talk about the idea of diversifying our taxes in retirement, because we diversify our investments, we diversify our income streams, we diversify our risk. So what about diversifying your taxes? And so you can see that that's the idea. If everything in your tax deferred is going to be taxed ordinary income, then you have to then decide, all right, well, what's my ordinary income tax bracket going to be? Is it going to be the exact same? If it's going to be the exact same, that's best case scenario, right? Best case scenario is it's 22% today, it's probably 22% tomorrow. When they talk about cutting taxes, it's rarely talking about just the regular tax brackets. And so even if we cut them a little bit, would it be enough to move us into a lower bracket, right? That's the question that we really have to think about when we're planning for the future. And then that leaves you with everybody's favorite bucket, which of course is going to be tax-free money. So tax-free money, that is, generally speaking, is going to be your after-tax investments for most of them. Uncle Sam likes to have one bite of the apple. He's not in the business of giving his money without it being taxed at all. And you really, if you talk about it, even if he gave you the money without it being taxed from one thing, it'll be taxed on something, right? I mean, there's a gas tax or sales tax, there's property tax, there's income tax. I mean, there's taxes all over the place. So don't you worry. Uncle Sam is in the business of collecting tax revenue. But he does give us the option of tax-free income. For those that don't know, the U.S., we currently have an incentive-based tax system. A very fancy way of saying that Uncle Sam likes to bribe us with less taxes if we do something that Uncle Sam's excited by. Right? For example, we give lots of discounts for families that have children. Because if you look at the data, industrialized countries don't have as many children anymore as agricultural societies. So if you look on the continent of South America and Africa, they have a lot more children per family. Because agriculturally, even in the United States, back in the good old agricultural days, my children used to be my retirement plan, right? I had a farm, I had land, and then my children would work on the farm. So if I had a child, they could work on the farm. They generated an income. They provided value to the family. And then I would pass the farm on to them when I retired, and then they would take care of me on the farm, and we would live happily ever after. Well, industrialized societies, you can't take your children to the factory with you, right? You can't take your children to most of your jobs with you. So as a result, people will see children as an expense in industrialized societies. I know it doesn't sound like a nice thing to say, but it really is. We're just talking about the economics of things. And so they have less children in industrialized societies. And you find in Russia, they're net negative. Most of Eastern Europe is net negative. Even Japan, they're shrinking, net negative. And then you look at the United States, we're considered flat. We're constant. We haven't lost and we haven't gained. And a lot of it has to do with immigration in the United States. But when you look at the people that kind of already been here and talk about European descent, they're just having fewer children, right? So you see that. As a result, Uncle Sam said, I want to make sure that we have enough children. So I will incentivize you to have children. I will let you write off taxes. I will help you with adoption. I'll give you like $15,000 toward adoption. Please have children. How about I pay for your VPK? Will that incentivize you to have children? So Uncle Sam is doing all these things because Uncle Sam wants to incentivize you to have children. And then when you look at the other two main goals Uncle Sam has, he wants everyone to have a job because he assumes people will pay lots of taxes if they have nice jobs. And so as a result, if you open a business, Uncle Sam gives you lots of favorable tax breaks for business owners because he's like, hey, you're going to help people get jobs. You're going to generate revenue. We're going to be consuming. Life is going to be rainbows and Skittles. So business owners get that. And then he wants you to have a house to live in. So Uncle Sam gives a lot of favorable tax breaks for real estate investors who provide home. Your rental income is taxed at a much more favorable tax rate. Uncle Sam's like, I want people to have jobs and houses to live in. And I want them to have kids. And of course, he has other incentives, and we'll get into some of those, right? Like college at 529, playing different things. But we know that Uncle Sam has an incentive-based tax system. So if it's something that is okay with you from a moral and value perspective, and Uncle Sam is saying, I would want to encourage you to do it, then I would say, hey, that's something we can have tax-free income. Your retirement falls in that same window where Uncle Sam's like, I want you to be able to sustain yourself in retirement without you having to rely on Social Security. Because as I told you, it's right on the website. It says we do not want Social Security to be your only or main form of retirement income. And so Uncle Sam said, I want to help you. So let's start with some of the overall expenses. We know that the best one, of course, is the health savings account. We always start there. That is the one exception. Uncle Sam knows that your healthcare expenses are huge. And so he says, I will allow you to deduct that income from your taxes currently, and you put the money in tax deferred. And you've already seen all our other tax deferred or tax ordinary income, but not your HSA account. The money then grows, tax deductible, then your money grows tax deferred. So you're not taxed every year that your account is going up in value. And then as long as you spend it on healthcare expenses in retirement, the money comes out tax-free. Uncle Sam said, I want everybody to be able to afford to go to a doctor. I don't want to have to pay that hospital bill. We got you. Don't worry about being taxed from that, right? So Uncle Sam already covers you from that. We also know, and you probably hear a lot, we talk about the Roth. And so the Roth is an after-tax investment. It means that I've already paid taxes on the money. It's in my bank account. And we already mentioned that if the money is in my bank account, that means it's already been taxed. So I can then invest the money inside of a Roth account. And then that money grows tax deferred. So I don't pay taxes on the growth. And then the money comes out tax-free. And I can spend that in retirement, which is pretty nice. Uncle Sam likes to incentivize us to invest in our local city projects. We're building bridges and roads. I don't know about your road and construction, but I feel here in Florida, we have construction on roads every single year. And by the time the project finishes, they're on to expanding the road again, that there's never a time that you don't see construction. And so the government will incentivize you for, that's what happened. I was spelling it wrong. I was like, man, that looks so wrong. Let me clean that up a little bit. All right, so all right, so municipal bonds. So those are going to be at your state and city level. The most favorable that you'll get is if you invest in your own state's project. The states sometimes are nice with each other where they're like, oh, sure, you invest in another state to build their roads. Sure, no problem. We'll allow you to deduct that from your taxes, but not always. So if you're ever curious or just nervous, it's normally a good idea for you just to invest in your own city's projects and your own state's projects, and then you'll normally receive that favorable tax rate from that. You also hear people talk about it all the time, and we'll discuss that as well. This is where life insurance will be. So you would either refer to this as whole life or permanent. Either one's fine. Whole life or permanent, either one's fine. And so there are some strategies that you can use the life insurance. And so we do talk about that. Those strategies do exist. It's just if that's the first one and that's the only one, it's kind of the way that it's generally made sound. And that's not the case at all. We're not saying that. But you do have these options that are available. So we talk about whole life insurance investing. That is going to be money that is tax-free as long as it doesn't MEC, which is a very fancy way. For those who don't know, right, we're saying MEC. And all a MEC is a modified endowment contract. It's just a very fancy way of saying Uncle Sam realized a long time ago that people were using whole life insurance policies as tax havens, that they were just putting a whole bunch of money inside of those with no intention of really taking the spirit of the rule of having whole life insurance because I want to protect against the loss of life. And so Uncle Sam said, all right, I have a couple of rules. If you MEC, then all the tax benefits are gone, right? And then once it MECs, it's MEC forever. You can't undo it. You can't be like, my bad, Uncle Sam, I'll take the money out. Uncle Sam's like, no, right? So you don't really have that option that's available. So you won't worry about that. And then also when we talk about the Roth, and we'll put in parentheses, we'll talk about like the backdoor Roth, right? So we also hear that. And for those that don't know, a backdoor Roth is just a strategy where what you'll do is you'll take the money maybe inside of your 401k, and that is in a pre-tax. So you haven't paid taxes on it yet. And what you'll do is you'll pick a year and you'll say, I'm going to convert 10, 20, $30,000 from my 401k into a Roth. And when you do that, you're already going to pay taxes on it, because if I'm going to get it as tax-free income in retirement, that means that I have to at some point pay the taxes on it. So the reason we normally use this strategy is we're worried about our tax brackets, where in our mind, we're like, oh my gosh, I have required minimum distributions, and then I have my Social Security, and I may have my pension. I may have all these income streams later in retirement, and I don't have the ability to turn any of them off. Now, once Social Security starts, I can't not have that income. Once my required minimum distribution starts, I have to take the money out or face a 25% penalty. And if I have a pension, once that starts, I can't turn that off. And so sometimes what we'll do, just to give you a little bit of flexibility, is we'll say, hey, in my early retirement years, I have a huge drop in my taxable income. What if I just withdraw the income from my 401k, and then I will pay the taxes on that, and that may put me in my normal tax bracket, but now I have more tax-free money in retirement. And so these are normally going to be your three, like the three buckets when we're talking about tax diversification. High level, if you are someone who is in the highest tax brackets, most of the time that's where the discussion is about, should we be increasing the taxes on the wealthy, right? Pay their fair share, et cetera, et cetera. As a result, more times than not, you're going to max out all these accounts anyways. There's limits on all of them, what you can do, and you'll still have the money that's left over. So for you, it just normally makes sense to take the tax-free where you can get it, acknowledge that you're going to have everything filled up, right? So you can only put so much in your 401k as far as pre-tax. You can only put so much in your IRAs and SEPs and everything. So once you max those out, put the money in the tax-free. Once you max those out, you might want to consider the life insurance. That's a later in the strategy. It's not in the beginning of it, but a later in the strategy approach, where you kind of already maxed everything out from that perspective. If you're someone who's in the middle, like the middle class, but we feel like where the middle class is and isn't is kind of shifting, the middle class is sometimes a good idea for us to consider, well, maybe I'll have half. So we'll say maybe I'll have 50% in my pre-tax, and then I'll have 50% in like my after-tax. And I guess it really wouldn't be your tax-free, it'll be over here in your after-tax. Let me do that. Right. Okay. Right. So you really would have your 50% of your after-tax. So you're sort of in the middle. So that way, if you feel that someone all of a sudden gets put into office and they literally ran on promising to raise taxes, then you can say, all right, well, I already have 50% of my after-tax. I'm going to shift a lot more of my pre-tax into my after-tax so I can lock in my lower tax rates today. And that way you have a little bit of flexibility, a little bit of nimbleness. That if someone is elected that does the opposite, if they promise we're going to lower everyone's taxes, we're going to eliminate taxes, then you can be like, oh, okay, well, I'm already 50% in my pre-tax, so I'm going to go ahead and move more into my pre-tax. I'm going to wait for the taxes to be eliminated so I don't have to pay them later. And so you have that flexibility. If you're someone who's normally in below the middle class, for the most part, that is not in the conversation of who we're going to raise taxes on. For the most part, I'm not saying it won't happen because, right, I don't want to get in trouble. But what I am saying is that for the most part, that's not the discussion point. So you then get to give yourself, I would say for you, for the most part, put everything in the pre-tax, just pay as few taxes as you can today. And most likely in retirement, you'll end up with low taxes still. That's not as big of a concern for you. As much as you can put in the tax-free account, that's always a great place for you to put your money as well. And so that is kind of where those differences ultimately are. And so what we'll do then is we will basically put together what I would say is normally going to be the order of operations that you'd want to go through when you talk about building tax-free income. Before I do that, though, let me see, make sure everybody's good. They can see everything. If you have any questions or anything, I just want to make sure I'm still being seen. Okay, so I can tell that I am being seen, and hopefully this is making sense and helping. All right. See here. Says Monty King says, "Hey man, can I ask you what certificates you got, if I may ask?" Of course, you may ask. All right. So from certificates, so we'll talk about certifications, things like that. I took my certified financial planner exam and I passed it. I did the 2 years or 1 year class. I did the accelerated path. And so I should be, I mean, right now we're going through the final background checks, and there was a ton of people that took the CFP exam. And the last time I talked to them, they said probably by before the end of April, I should be cleared, everything's done, and then I'll have my certified financial plan. I'll be able to actually hold myself out as that. I also have a bachelor's in economics from Florida State University, and I have a master's in applied economics from Georgia Southern University. And then I've been just in the financial industry for close to 2 decades. I don't feel that old, but I've been there for close to 2 decades. I've worked for a lot of the Fortune 50 banks before opening my own RA. So I worked at Wells Fargo. I worked at Bank of America, not Bank of America. I worked at New York Life. I also worked at Deutsche Bank. The investment bank is German. It's their number one investment bank. And so I've been kind of in the finance industry for a very long time. And so I have the degrees, the background, and the love. I have the certifications. And then if you're curious, my next one will be the CFA, the Chartered Financial Analyst. That will be the next certification in my future on my things to do list. So I do think that's a phenomenal question, because it is true that there's a lot of people who are just giving advice and have no idea what they're talking about. And then currently, as a Obsidian Wisdom, my RA, I'm registered with the state of Florida, a licensed fiduciary. I go through my audits and my compliance and all that fun stuff. And so I'm also just a registered fiduciary with the state of Florida. And so we have that as well. So thank you. Hopefully that answers your question, my friend. All right. All right. So next thing I do want to go through with you all is the idea of a couple things. So one is, all right, Dre, I have all my money in these accounts. Is that it? Is there anything else that I can do? I'm glad you asked. There are other things that you can do. I'm going to go ahead and I'm going to move this off. So sometimes what we end up doing is, once we get past all these different strategies, there's a couple things. So first, let's talk about charitable giving tax strategies. If you're someone who kind of maximizes everything else out, there's a couple things that you can do. One is called a donor advised fund. So, all right, that's donor advised fund. And so all the donor advised fund is a very fancy way of saying, I want to donate some money because I'm going to pay taxes, or I can donate to a cause I believe in. I'd rather donate to a cause I believe in. And so if I can do that, if I can donate to someone I believe in, but I haven't really researched it, I'm not sure I want to donate the money to yet, Trey. Like, no problem. We can open you up what's called a donor advised fund. So if you want the money to be for, the tax year, you have to do it by December 31st. It's not one of the ones that has a look back. And basically the way it works is you open up a investment account. And it is whatever you name it. It could be donate to Dre because I love Dre fund, right? It could be literally anything you want to name the fund. And then you place the money in the fund. As soon as you place the money in the fund, that is considered a taxable or a tax deductible charity giving. And the reason is because the donor advised fund is basically a irrevocable, trust. Like, once you put the money in, it's not yours anymore. You have to give it to a nonprofit, someone's 501c3. It could be your local one, it could be your church, it could be anything, but it's not yours anymore. You can't give it back to yourself unless you have your own nonprofit. So as a result, because you put the money in there, it's not yours anymore. Uncle Sam will say, all right, that counts as a charitable donation. The cool thing, though, is the money grows. And that grows tax-free. Right? How cool is that? So the money grows tax-free in your donor advised fund. So you put the money in there, you're like, hey, look, I'm gonna donate. Let's just say, like, hey, I go to church, I donate $1,000 every Sunday, so it's $52,000 a year. You can put the $52,000 inside of your donor advised fund. It then grows over the year. And so you're actually able to donate, whatever that difference is. So let's say it added another $3,000. That is not taxed to you, but you do get to give that and donate. And then obviously you're supporting the causes. So kudos to you. Right. So we're supporting the cause. So that's the way a donor advised fund. If I'm not sure where I want to donate the money, but I know that I want to donate it. Maybe I sat with my CPA and they said, hey, we need to donate $50,000, $20,000, $5,000, literally, it doesn't matter. Or we're just going to eat it in taxes. You can say, all right, cool. I don't know who I want to give it to yet, but Dre said I can open up a donor advised fund. I can at least lock in that tax deduction this year, and I can figure out who I want to give it to in the coming months. Totally, you could do that. And that's what a lot of people enjoy doing. And it's definitely something that it just separates the idea of, I got to research all these 501c3s to make sure I believe in the mission, to make sure that they're giving enough of the revenue towards the cause and not towards the cost of operating. All these things take time, and you may not have as much time as you would like. Well, this gives you more time where you're going to be able to sit there and say, oh, okay, I put in the donor advised fund. It's irrevocable. I can't take it out, but I can now deduct it from my taxes. So I'm good to go. The other one would be considered a qualified charitable contribution. And so, right, just in case, right? So by qualified, all right, charitable, I probably messed that up. Contribution. All right, so if I have my qualified charitable contribution, this one is if you find yourself worried about required minimum distributions later in your retirement. So this is only available for people who are over 70 and a half. And then currently it's set where at 73, you would have your required minimum distributions get started. And it's a table. It tells you go by your age and the number, you divide it out, how much money you have, and it tells you how much out of your pre-tax investments, money that hasn't been taxed yet, all of them total, you have to donate in that year, or at least you have to take out an income in that year. And whatever that amount is, you have to take that out, or else it'll be penalized at 25% penalty. They had lowered it in the most recent years. And it's a very fancy way of saying that it's been tax penalized. And for most people, if I have to choose between taking the income out or being tax penalized, I like to take it out. But then I'm worried about being in a higher income tax bracket and I don't need the money. So what do I do, Dre? I'm glad you asked. You would have a qualified charitable, or actually that's not it. It's a distribution, not contribution, distribution. I was like, man, I think it's a QCD. Why do I have QCC? Because it's a distribution. That's where the D is at. All right, we're back together. We're on the same page. And so currently it's set where you're able to donate $108,000 in the year. It's indexed, so it goes up. It's basically $100,000, and then it goes up for inflation. It's indexed, it's tied to something. And so $108,000 is what it is in 2025. If you are a couple, then you can both give $108,000 in 2025. And the way that this works is, instead of it being my required minimum distribution accounts that then come for me, that I then get taxed on, and the ordinary income, because it's coming out of my 401k, my 403b, and all those other accounts, I can now say, well, if I'm allowed to give up to $108,000 to any charity, well, now it's not going to be taxed to me as income. Now, it's important to note that you can't take the money and then give it to the charity. That's not how it works. You have to give it directly from your 401k or IRA to the charity for this to work. You cannot take the money. You cannot take ownership of the money. If you take ownership of the money, then it doesn't work. It's going to be taxed to you as ordinary income, and then you have the deduction from the transfer, but it wouldn't count as a qualified charitable distribution. And so you have that amount that you're able to do. If you're worried about paying taxes on a certain amount, then you can at least donate to a cause that you believe in and that you support. You have those options that are available for you. All right. Hopefully that makes sense. Does that make sense? All right, good. Okay. Yes, no problem. Thank you. I appreciate that. Let's see what else he asked. It says, like in the case of athletes who pay about 50% of their income as tax, how to manage this type of tax? Yes, for sure. And you'll find that a lot of athletes have nonprofits. like you see it, and I see the commercials all the time. Most athletes have nonprofits. They have causes that they believe in, that they love, of course, and of course. But if you're just going to pay it in taxes, why not set up something where you can use the money in the way that you want to see fit? I think most of us would agree that the way the government is spending the money, that I think everybody would have an issue with some part of the way it's spending. So when it's in your control, while the money is yours to decide with, yeah, set up a 501c3, donate that extra. You can do your own qualified contributions to your 501c3. You can donate to any of the causes, any one that you're on the board of. All these options are available for you, and so you do have that. And you see athletes do that all the time. That if it's going to be taxed anyways, right? If it's going to be taxed anyways, we might as well do what we want with it, in the sense of supporting a cause that we believe in, helping a local community, feeding families, all that stuff. You have these options that are available, and you find that that is what a lot of the wealthier people are doing, right? Because it's like, well, if these are my choices, right? I don't get to keep the money either way, right? That's the important thing. You don't keep the money either way. It either goes to the government or goes to a cause you want to support. What would you rather do? For me, I'd rather donate it to a cause I would support. And so that is what a lot of us end up doing. All right. And so I think we only have one more strategy to go through, and then you can basically decide what makes the most sense for you. Okay, we actually have like two more strategies to go through. This one I'm probably just actually going to share. I'm probably just going to make it easy for both of us, and I'll just simply share this tab with you, because it basically goes over. It gives us a nice example, so I don't really have to draw it up and all that. But one of them is called tax loss harvesting, and all tax loss harvesting is the idea that I'm going to lose money at some point in my investments. It's impossible to choose all winners, right? So AI hasn't done it yet. I'm not saying it may not one day, but it hasn't yet. And so what do I do when I have losses, right? Am I able to put a plan in place? And tax loss harvesting is a very fancy way of saying there's investment income that you have that you can take your capital gains, and you're only able to offset capital gains with capital gains losses. You can't take a loss of a type of income that's not capital gains, and the IRS uses it against capital gains. What does that mean? It just means that Uncle Sam looks at the income differently, and he wants to keep it nice and orderly. So if you have a whole bunch of capital gains income, then if you're looking at your investment portfolio and you see that you have a portfolio, you have a portion of it that's not performing well, and you're not that excited by it, right? That's the most important thing. I mean, right now, the stock market is losing, and it doesn't have little to do with your actual investments. Now, some of it, yes, some of it. But for the most part, it's the uncertainty, it's the tariffs, and it's the inflation. That's technically nothing to do with your particular investment choices. So if you are someone who's sitting there like, well, I don't want to sell that investment because I still believe in that company, I think that's still a great investment, then I'm not talking to you right now. What I am saying is, if there was a change in leadership, if there's a change in strategy, if there's a change in the market in some way, shape, or form, or consumer sentiment and the way people make their buying decisions, if that makes your investment a less exciting investment, don't be bothered by the fact of selling it at a loss. Just use those losses to offset your gains. And so here's an example that you can see. And all we're saying is if I had $20,000 that I generated from my investment, and I had a $25,000 loss from my other investment, I am able to use the loss to offset the gains, right? So instead of me having $20,000 of income over here, I then get to offset my gains. I get to apply it because it's the same idea. It's the capital gains versus the capital gains. It's not ordinary income and capital gains. You can't do that. You can't do ordinary income and capital gains, but you can do capital gains and capital gains. And so if I have an investment that is losing that I don't like anymore, and I want to sell it, I can then take a certain amount, offset my losses, and then I'm able to roll forward another amount that I can apply in the future. And when you see people and you're like, how is that these people have all this money and they're not paying taxes for decades, right? They're carrying losses forward. The government allows you to do this with your investments in stocks because remember, we said that the government wants to incentivize people. We have an incentive-based tax structure. They want people to have jobs. And so if you're investing in stocks, you're technically investing in a business. If you've achieved capital gains, that means you've invested for a year and a day, which means that you've allowed the business to hire and to grow. So Uncle Sam then opens up the capital gains tax bracket or income bracket, And as a result, you now have the ability to offset these other capital gains losses. And so that's all this is. The same is true. It's not the exact same, but you have the same ability with your real estate. You have the ability to take losses in your real estate and offset them and carry it towards the future and offset future years of gains as well. And it's the same idea that we just mentioned again. Uncle Sam also wants people to have houses to live in. And so Uncle Sam wants people to have houses to live in. He said, all right, look, I'll let you carry losses forward. Well, cool. I'm a long-term investor. If my long-term investment is growing and I can take the losses in my early years and spread them out, that's fine. Uncle Sam says, sure, of course. I want you to be in this for the long term. Same with your real estate. I want you to be in this for the long term. And so as a result, you see that Uncle Sam is always incentivizing us to do things that obviously he wants us to do. And as always, I'm not saying chase the tax returns. That's not the goal. We have a plan and we're just simply being efficient with the taxes. We're not chasing a tax deduction. We're not looking for losses. We're not going and investing in penny stocks to offset our gains. We're out here trying to make the three streams of income so that we can have the money that we need to retire, purchasing all of our time back and spending it how we want to without trading time for money. And that's the goal that all of us have. If you have losses, it's just simply a way to look at them. Oh, all right, I got losses. Oh, cool. I can use that to offset some of my gains, right? Losses is a part of the game. And so as a result, you give yourself that opportunity to be able to do that. And so that normally works pretty well for people.